Hello and welcome everyone. In this video, we are going to take a look at the CLSA ETF from Brompton. And this ETF holds all the Class A shares from the most popular split corp funds on the market. And of late, this ETF, as well as just Class A shares in general, have become quite popular because they are outperforming the broader market as well as their underlying holdings. In fact, if we compare the performance of CLSA with other broad market covered call ETFs like HDIV, HYLD, and USCL, we see that over the past 1 year, this ETF has greatly outperformed all those ETFs. In fact, its return is almost twice as much as the other ETFs. So this begs the question, is this an excellent investment or is there a catch? And this is where I wish to highlight the additional layer of risk that comes with this type of investment. So in this video, we will cover the following topics. First, we will take a look at the overall structure and strategy of CLSA ETF. Then we will calculate the amount of leverage that is being used in this ETF. Even though this fund does not borrow any money from external sources, Class A shares themselves use structured leverage within the fund. So it is important to understand how much leverage we are actually dealing with. We will also take a look at the sector allocation within CLSA. And lastly, I will offer my conclusion on whether this is a great buy right now or maybe we should wait for some time. All right, without further delay, let's get started. As mentioned earlier, the CLSA ETF holds the Class A shares of the most popular split corp funds on the market. And in essence, it serves as a fund of funds for Class A shares. The main idea behind this is that people no longer need to worry about their dividend being cut during a bearish market. One drawback of Class A shares is that when the unit NAV of the split corp fund goes below $15, the Class A shares stop paying out income until the unit NAV recovers back to above $15. And this generally happens during a bearish market. But CLSA solves that problem by acting as a fund of funds for all the Class A shares. So even if some of its Class A shares stop paying out income, there will be others which will continue to pay out the income because they were able to sustain the $15 NAV threshold during the bearish cycle. So this ETF, in essence, is expected to pay out regardless of whether we are in a bearish or a bullish cycle. Although it must be highlighted that during a bearish cycle, the income paid out by this ETF might go down. We haven't had a bearish cycle since the launch of this ETF, so we do not know yet. But there is a high probability of that. I have also included a brief explanation of how split corp funds work for those of you who are not familiar with it. In a split corp fund, the holdings get divided into two classes of shares, the Class A shares and the preferred shares, hence the name split corp. And the way these two classes work is that the Class A shares absorbs all the underlying holdings volatility, while the preferred shares maintain a stable net asset value. In other words, the Class A shares works like a leveraged version of the underlying holding, while the preferred shares work like a fixed income asset. And for this reason, Class A shares end up paying a higher income yield compared to the preferred shares. They also generally pay out on a monthly basis, whereas preferred shares pay out on a quarterly basis. But as mentioned earlier, if the net asset value of the overall fund goes below $15 per unit, then the Class A shares stop paying out the income. The preferred shares, on the other hand, will continue to pay out their income. Once the NAV recovers back to over $15, the Class A shares resume paying out income as well. The key takeaway for us is that the Class A shares absorb the underlying holdings volatility. Since CLSA only holds Class A shares, it is basically holding only those types of shares that work as a leveraged version of the underlying holding. And this makes it very important for us to understand how much leverage we are actually getting when we are buying CLSA. I have done the calculation for this, and here are the results. The table you see on the screen lists all the holdings within the CLSA ETF. The first and the second column give us the list of providers and the ticker symbol for each holding. The next two columns give us the unit NAV and the Class A NAV for each holding. One good thing you might notice is that the unit NAV for all the holdings is above $15. So all of them are paying out their income, which is great. In the fifth column, I have calculated the leverage ratio for each holding. We get this number by dividing the unit NAV by the Class A NAV. And one thing you might notice is that the leverage ratio for each of these holdings is quite high. For most covered call ETFs, we are generally used to a 25% leverage. But these holdings are using anywhere from 60 to over 100% leverage. In the last two columns, what I've done is I've taken the average weight allocated to each holding within CLSA and multiplied it by the Class A leverage ratio for that holding. The resulting number is the actual leverage we are getting for each holding when we buy the CLSA ETF. When we add up this number for all the holdings, we get a total of 188.60%. In other words, CLSA is using 88% leverage. Now, to be fair, this number is not completely accurate because I was not able to get the unit NAV and Class A NAV numbers for all the ETFs for the same date. So most of them are quite recent within the last week, but the ones from QuadraWest are from about a month ago. So if we were able to get the exact numbers from the same date, this number might be slightly different, but we get the overall idea. Even if we round it down to 80%, we are still dealing with an 80% leverage compared to other ETFs such as HYLD, HDIV, and USCL, which are only using a 25% leverage. With this knowledge, when we look back at the 1 year return for these ETFs, it is not difficult to understand why CLSA has outperformed so much. It is a highly leveraged investment which will perform better during a bullish cycle. In fact, if we take a look at the sector allocation within the CLSA ETF, it is mainly concentrated within the Canadian banks, North American financials, life insurance companies. All of these sectors have done really great over the past 1 year. But if we if these sectors run into a bearish cycle, then this chart could end up going in the other direction as well, along with the potential for lower income payouts. So where does this leave us with regards to CLSA ETF as an investment? Well, let us take a look at what we have learned about this ETF so far. First of all, it holds mostly defensive sectors, which is great. But at the same time, through the split corp fund structure, its Class A shares are highly leveraged and which averages to around 1.8x or 80% leverage, which is a lot higher than the regular covered call ETFs. And because the underlying sectors, which is mostly banks and other financials, have done great recently, this ETF has greatly outperformed the broader market during the bullish cycle. But it could just as easily underperform if the markets turn bearish, especially for the sectors in which this ETF is concentrated. Not to mention, during a bearish cycle, there is also a greater potential for reduction in the amount of income being paid out. So even though CLSA does solve the problem of completely losing out on the income, which is inherent to just a single Class A share, it does not completely do away with it because some of its Class A shares are bound to not pay out income during a bearish cycle. So the amount of income will most likely go down. And we are yet to see how this ETF performs during a bearish cycle. With that said, I do hold it in my TFSA, uh, but it is a very small position, about 3% of the total portfolio. And that is where I think this ETF fits. I would personally not use it as a core position, but I don't mind having it as a small position that helps boost both the income and the growth of the overall portfolio. With that, we come to the end of this video. Let me know if you hold this ETF or are planning to add it to your portfolio. If you found some value, don't forget to like, share, and subscribe. I will see you all in the next one.